Global markets are holding tight ahead of US price data. Australia's business conditions fall, and that's okay for the RBA. India's food prices accelerate, but inflation is close to forecasts. And there was good and bad news on New Zealand's inflation front yesterday. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Chief Economist for Greater China, Raymond Yeung, says the Chinese Politburo's recent shift on property policy shows authorities are facing up to the reality of high inventories and low demand.
Now that the Chinese government is willing to admit this is a big problem, the supply-demand imbalance has to be addressed.
But first in 5 and 5 with ANZ. Global markets are in a holding pattern as traders await key US CPI data on Wednesday night. To find out when or if the US Fed can start cutting rates this year. Federal Reserve Vice Chair Philip Jefferson said overnight that rates should remain in, quote, restrictive territory until, quote, additional evidence shows inflation is moving towards 2%. The consensus forecast is for annual CPI of 3.4% in April from 3.5% in March. The S&P 500 was down just a touch, and US Treasury yields were 1 to 3 basis points lower at 5 a.m. Sydney-Melbourne time. The Aussie dollar was firm at 66.06 US cents, as was the Kiwi at 60.16. The US dollar index was down slightly. ANZ Head of FX Research, Marja Ben-Zaman, expects the US dollar will remain firm through the week, barring a large CPI surprise, and says traders will want more clarity over where inflation is heading in May and June, rather than just April.
What we have seen over previous instances is when CPI comes below expectations, I think the first couple of days you do see a little bit of that weakness in the dollar, but then beyond that it starts to move up again. So again, that comes back to our view where we continue to think that at least for the rest of the Q2, which is May and June at the very least, we're going to see dollar remain at least firm where it is until there's more clarity around the CPI over the next few months.
Number 2, NAB's Australia Business Confidence Survey for April found another slide in conditions toward its long-run average, which ANZ economist Maddie Dunk says is consistent with a slowdown, but not a particularly fast one.
I don't think too much to concern the RBA in this survey. We saw that labour cost growth and purchase cost growth both eased, while final price growth did pick up a touch. When you look at those cost indicators as a whole, what they're telling us is that inflation should continue to moderate. So broadly in line with what the RBA would be wanting to see.
Number 3, India's annual CPI data out overnight showed a 4.83% increase in April from a year ago, and that was close to expectations. ANZ economist Dheeraj Nim says while there was a concerning acceleration in food prices, core inflation was steady at 3.2%.
Whether it's a strong PMI, decent exports, and a sweet run of some other data as well, they continue to point resilience of growth, which means that the monetary policy can remain hawkish for longer to bring inflation down to the target 4%. We have recently revised our rate cut call. We now expect the first rate cut by the Reserve Bank of India in December, and a total of 3 rate cuts of 25 basis points each.
Number 4. There was some good news and some slightly concerning news for the Reserve Bank of New Zealand on the inflation front yesterday. Selected price indices for April were slightly stronger than expected, but inflation expectations, measured in the Reserve Bank's own survey of forecasters, it fell. Here's ANZ economist Henry Russell.
While these data will add to the Reserve Bank's confidence that inflation is returning to target, what we have seen across inflation prints recently is a divergence across the basket. And while a lot of the weakness in inflation or the disinflation we've seen to date has come through on the tradable side, whereas domestic inflation continues to prove far more persistent. And this is really the component that the Reserve Bank needs to see progress on for it to be confident that inflation's trajectory to 2% will be sustainable.
Number 5. New Zealand's services sector contracted again in April, according to the BNZ Business NZ PSI survey. ANZ senior economist Miles Workman says this presents downside risk to the GDP forecast, but that the Reserve Bank is still faced with higher services inflation than it would like.
We're still seeing services inflation and non-tradables inflation continue to surprise the Reserve Bank's forecast to the upside. So the data that we see today adds confidence, perhaps, that the pipeline disinflation is on the way, but at the same time, we're still getting a few signals and other pieces of data that suggest the starting point for inflation pressures is perhaps a little bit higher.
Miles Workman there. Now, in our bonus deep dive interview, ANZ Chief Economist for Greater China, Raymond Yeung, says China's Politburo has made a recent shift on property policy to focus on inventory build-up, and it's something he's never seen before.
What caught the market attention is they specifically changed the wordings about the property policy, and they claim to, with a special aim to reduce the property inventory in the market. I think I've never seen a statement like this. It's so specific, pointing to the fact that now they realize the problem of the property market is the inventory pile up. We had previously estimated that the inventory level, including those that will be coming to the market as a potential supply, versus the sales run-up now, it will take around more than 3.5 years to digest all the inventory. And now that the Chinese government is willing to admit this is a big problem, the supply-demand imbalance has to be addressed. So the market is now expecting the government will launch many policies, measures to induce demand as well as controlling the future supply going forward.
What sort of policies could they bring in to increase demand and reduce supply?
It is widely expected that many local governments will relax the ban for purchasing more than 2 properties. And in fact, a latest announcement that we've got today is that even the Beijing government is allowing people who have reached the limit of buying Beijing property within Zone 5, which is a central area of Beijing, will be allowed to buy additional property outside Zone 5 in Beijing. So that's a big development. I believe that now, even for Beijing, Shanghai, Guangzhou, and Shenzhen, these top cities have already relaxed their property purchase ban, and that's indicate the government is now willing to have a complete relaxation of property banning, purchase banning, so that that can induce more demand to address the supply-demand imbalance. In terms of property inventory, this is the big target because they know that as long as you got high level of property inventory, and buyers will know about that, and buyers, will not be too keen to buy property because of such a high level of inventory that will weigh on their buying appetite.
In the statement, the comment that houses are for sheltering, not for speculating, was taken out. How important is that, do you think?
It is very important because this is the second time that the central authorities did not use this statement to describe the overall housing policy. And remember, the first time they talked about that was back in April 2021 when they started to tighten the property market. And the top authority doesn't really want to use property market to drive economic growth, but rather they regard housing is housing. Housing is for livelihood. And they also describe housing as one of the 3 big mountains, very poetic in terms of how they describe the overall social policy. The 3 big mountains refer to housing, medical, and education. So now that they realize a very special status or special role, properties can play in the overall economy versus education and medical, they realize the economic contribution of property is not only on the property or construction sector, but with an overall impact on the macroeconomic outlook. So we moved this statement in the Politburo statement this time. And in fact, now they specifically mention about inventory reduction. It seems to me that they realize the supply-demand dynamics is even more important. And this statement is becoming more market-oriented compared with the previous Politburos in the last few years.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, May the 14th. Catch you tomorrow with a further build-up to the US CPI and detail from the Australian budget. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.